The sell-off in U.S. markets after a stronger than expected September jobs report. The Dow Jones sank about 630 points. The Nasdaq lost more than 420, and the S&P 500 fell more than 100 points. Despite Friday's losses, stocks still finished the week with modest gains. With more market analysis, we're joined by Colby Smith. She's a U.S. economics editor for the Financial Times. Colby, what explains Friday's big sell-off?
I think it was a real recognition that the efforts to cool down the economy are really going to have to ramp up from here on out. The labor market just remains quite resilient, and the Federal Reserve, which is trying to tame very high inflation, is going to have to continue raising interest rates for the foreseeable future. And when we get good economic data, like another month of strong jobs growth and the unemployment rate ticking down, it's actually really interpreted as perhaps a bad thing, meaning that there's going to be more restriction on the economy for longer and perhaps more aggressively in order to get inflation under control.
So just to be clear, with this new jobs number, you are not seeing any evidence that the job market has finally cooled off?
I mean, we're seeing incremental cooling on a month-to-month basis. Jobs growth is slowing, but this 263,000 pace is quite elevated. And it's really not what Fed officials want to be seeing at this point when they've raised interest rates as high as they have. In just 7 months or so, interest rates have risen by 3%. That's a record pace, something we haven't seen since the early 1980s. And at this point, I think a lot of economists thought we would have seen more cooling in the labor market, a higher unemployment rate at this phase. But that's potentially just showing us how strong the underlying economy really is.
We're a month away from the midterms. Is another significant rate hike by the Fed expected early next month?
Expected, I think, is the right way to frame it. A lot depends on the inflation data incoming next week. That's going to show price pressures for the month of September. Now, the Fed has said, they're data dependent. So each rate decision is based off of, in the aggregate, the data they see in the intervening periods between their policy meetings. But I think expectations when you talk to economists is for inflation, again, on a month-over-month basis to remain quite elevated, especially for core measures, which strip out volatile items like food and energy. And that really just shows how robust underlying inflation is. And I think that's really going to set the Fed up to have to do yet another large interest rate increase of 75 basis points.
I feel like you're reading my mind because the CPI was my next question. So you are expecting not good data in the sense that it's not going to tell the Fed that they can ease back on the rates.
Right. That's exactly the fear here. We have seen a rolling over of some gasoline prices in the previous period and some moderation in certain categories. But it's quite clear that when you strip away all of those, bigger ticket items, services inflation is quite elevated. Rental and shelter inflation is quite elevated. There's just quite a lot keeping upward pressure on inflation, and the month-over-month reading is not expected to be slow enough for the Fed to say, we can really slow things down. Now, that being said, even if they were to moderate from a 75 basis point hike to a half of a percentage point interest rate increase, that's still quite a lot of tightening. So it'll be interesting to see how they discuss the incoming data as we still have a couple more weeks until that next gathering.
In its simplest terms, what accounts for this historic rate of inflation?
So it's a combination of things. I mean, on the one hand, you do have these supply pressures, and that has really helped to bid up prices. And that's something that's outside of the Fed's control. So the war in Ukraine led to an energy shock that filtered through to other categories. So we had food prices rising as well as a result of that conflict, and other key categories. But at the same time, we have a really strong consumer. So demand is elevated across the board for goods and services. And that's really what the Fed can control here. So what its aim is to crimp demand, slow it down so it can come better into balance with supply that remains quite constrained as the war continues. COVID disruptions crop up every now and again, and globalization as a whole, has really stalled to a certain extent. So ultimately, what we're seeing is that inflation is potentially becoming a much more persistent problem, and the longer it stays elevated, the harder it will be for the Fed to root it out.
Colby Smith, thank you.